Karthik, talk to us at this stage. Any expectations of a possible rate cut in the near future stands to be questioned.
You're right, Krishna. In fact, like you mentioned, it's been almost 2 years. In fact, when the next Monetary Policy Committee meeting happens in the month of February, it would be exactly 2 years since we saw the rate being hiked to 6.5. Now, US has been cutting rates. We've seen rate cuts even in economies in the European Union region. But that doesn't seem to be bothering Shaktikanta Das at this moment. In fact, there has been pressure on rate cut even from two union ministers. We've had Finance Minister Nirmala Sitharaman as well as Commerce and Industry Minister Piyush Goyal urging the Reserve Bank of India to consider cutting rates. But I think the Monetary Policy Committee's stance is fairly clear that they want to hammer down inflation to 4%. Plus minus the 2% threshold that they maintain. So at this point of time, for the next 2 months at least, yes, there is going to be absolutely no possibility of a rate cut. But there's more to the Monetary Policy Committee meeting and the announcement that, the RBI governor made today. And most worrying on that front is the reduced estimate on the GDP growth for this financial year. Now, that has been revised downwards from 7.2% estimated earlier to just about 6.6%. Now, all of these, obviously, Krishna, as you understand, are linked. And how this is linked is the fact that we know food inflation is high. The RBI also understands that food inflation is not something that can really be controlled by keeping demand low and hence keeping interest rates high. Now, at the same time, the GDP growth projections that came for the second quarter came below expectations at only 5.4%. So that has overall reduced the tally and taken that down, the projections for FY25, which is this financial year, down to 6.6%. From 7.2% estimated earlier. So that's obviously a bummer for the economy. What this means is that we will not see the capex cycle pick up, the private capital expenditure, which is going to be instrumental in creating jobs and giving salaries to people. So no real hope on that front in the foreseeable future. Now, just to add to some woes of consumers and those who intend to take a fresh loan from, from any financial institution. Now, with the repo rate being intact, obviously there's no question of EMIs coming down, but you may not actually also get the same interest rates on your fixed deposits. And this comes by way of the Reserve Bank of India actually cutting down the CRR or the cash reserve ratio. I'll just take a moment to explain to our viewers what that really means. Now, there's a stipulated requirement of all regulated financial entities, including banks, to park a certain amount of their money, their deposits with the Reserve Bank of India. Now, that stood at 4.5% until this morning, and that has been revised now downwards to 4%, which means on every 100 rupees of deposits that banks get, they were earlier expected to keep 4.5 or 4 rupees 50 paisa with the RBI.
Right.
Now they need to keep it to 4% or just 4 rupees, which means the RBI is trying to inject more liquidity to the tune of 1,16,000 crore rupees in the banking system. This means banks actually don't really necessarily need to go and seek money from the RBI to actually give interest back to the consumers, and this money available to them can now be circulated, which means there is no need for banks with this additional 1,16,000 crore rupees coming into their kitty to actually offer consumers the interest rates that they have been offering, and hence those interest rates may come down while home loans will not get any cheaper.